So the goal now is to look at what they're projecting out, how they're handling their debt, and growth rates going forward, what can we expect, and then plug them into our models to see what kind of price target we can get here. So last night, Warner Brothers Discovery and Disney decided to partner up, and by the summer, there's going to be some sort of package between Disney and Warner Brothers Discovery. Now, Warner Brothers Discovery just dropped earnings. We're going to get into the earnings, update our models, get a price target for Warner Brothers Discovery. What the heck is going on with the stock? As we can see here, this has been a very ugly story for streamers overall. The only one that's really winning or getting close to winning, obviously Netflix is way ahead of the game, but Warner Brothers Discovery is in a tough spot, and one of the hardest things to put a price tag on is the intellectual property that a lot of these companies have, and Warner Brothers library is probably one of the most extensive libraries out there. This looks to be a miss on both top and bottom line. They were expecting about 10.9 billion in revenue. They did 9.9 billion in revenue. And when it came down to an EPS standpoint, it was a negative 40-cent hit versus a negative 27-cent hit. And we can see that the price is down roughly 3%, but after an earnings miss like this, usually you see a stock down 15, 16% here on a double miss, especially lately in this market. But that's why I'm saying that we might be seeing a bottom here for Warner Brothers Discovery. The stock just might be getting so cheap that the assets by themselves are probably at break even at this point in time. So the goal now is to look at what they're projecting out, how they're handling their debt, and growth rates going forward, what can we expect, and then plug them into our models to see what kind of price target we can get here. They are aggressively paying down this debt. Repaid 1.1 billion debt during Q1, ended the quarter with 3.4 billion in cash. So they still have 3.4 billion in cash on hand and 43.2 billion in gross debt, which gives it a net leverage of 4. You guys can see here where my price target is for Warner Brothers Discovery. Definitely below $8 a share, the stock gets a little bit interesting. And you can see where I have that projecting doing revenue for 2024, right around 41.6 billion. So the thing I want to highlight here is cash and cash equivalents are actually at 3.4 billion, and debt is already down below. So we updated the balance sheet a little bit here, knocking some more of the debt off and then adding in a little bit more cash. So they increased subscribers by 2 million. So net losses came in right around $1 billion. And that includes a nearly $2 billion pre-tax acquisition, amortization of intangible content fair value step up. We can see that the net losses are coming down as well, which is good to see. Cash provided from operating activities came up and free cash flow came up. So this is a tough one to read through because you're looking and you're seeing the decrease in revenue, but there's some efficiencies picking up here. They're paying down the debt. They still have a decent amount of cash on the balance sheet, but we really have to look at where growth trajectories are. Looks like studio segments took a pretty substantial hit, being down 70% on adjusted EBITDA basis. Network segments were down roughly 8% from an adjusted EBITDA basis as well. And only 1% growth on direct-to-consumer distribution, which came down to adjusted EBITDA going up 72%. So we can kind of see the inefficiencies and the efficiencies with the business. Some positives, but definitely some negatives when we're trying to talk about overall business segment growing as a whole. I definitely think this is a confusing earnings report. Let's see where the stock is at. The stock is down roughly 4% right now. And when we bring it down to an ARPU basis, it came down from $7.94 to $7.83. So it's average revenue per user. It came down a little bit, so that's obviously impacting revenues here. So they're attributing their cash flow to more disciplined approach to content investments and the timing of productions. So a few things we need to talk about when we're talking about the entertainment businesses. The thing I like of the recapture of box office sales. So they can make a blockbuster, put it out there, put it out in the cinema, but then also recapture it direct to consumer, which I kind of like about their business model. It's almost like free advertisement for the company. So multiple ways to kind of capture revenue through, but the issue is definitely coming down to the growth factor here. The growth rate is non-existent, even though they're becoming more efficient. So I'm slowing down the growth rates here because I didn't see anything for projected 2024 guidance. And if something comes out, leave a comment down below, let me know. But I'm going to just kind of do a jumping off point here. So they're doing 9.9 billion in revenue. That comes out to be about $39.6 billion of top line revenue. I had them guiding for right around 41 billion. So we updated our models here. We updated the balance sheet. We got them doing 39.26 billion in top line revenue and then steadily growing from there, which then gets me an ideal price target around $7 a share and a fair market value of roughly $20 a share in 2030. So that's my update. Definitely not what you want to see. But here's what you have to understand about the entertainment businesses. The entertainment businesses is very much kind of like your biotech businesses, where when they get stuff in their pipeline, that's when they become the most valuable. So we see all this weight loss drugs, and you see these biotech companies exploding off of the weight loss drugs. Well, if you get 5 or 6 pieces of content in your library that are new and everybody's interested, and you get more subscribers and you're recapturing box office pictures, then all of a sudden you see an explosion in the stock price. But what we've seen lately is there hasn't been a tremendous amount of spend in content creation lately, and they're obviously staying focused on where their money is going. They're paying down the debt. They're really staying focused on where they want to invest their money. And when we think about the writer strike that took place, there's been an absence of content creation here over the last year that needs to start catching up. So this is definitely one that you need to be patient with. This is definitely one that's a high risk, but this is kind of my analysis on Warner Bros. Discovery. So hopefully y'all enjoyed. We'll see you in the next one.